Welcome to this Nedbank Financial Market Educational Series, proudly brought to you by our online share trading division. Learning about trading and investing is essential for every client, as this will equip you to make more informed personal trading and investing decisions. In this educational video, we will discuss exchange-traded funds, better known as ETFs. Please note that this session is on both a beginner and intermediate level. Please refer to our disclaimer. In summary, you cannot regard this session as any trading or investment advice, as the information has been provided for educational purposes only. Let us begin this session. So what is an exchange-traded fund, or ETF? An exchange-traded fund is a type of investment fund or an exchange-traded product that is traded on a stock exchange. This type of product tracks an index, sector, commodity, or other asset, which can be purchased or sold on a stock exchange in the same way a regular share can. The ETF can be designed to track anything from the price of a specific commodity to a large and varied collection of shares. ETFs can even be designed to track precise investment tactics. ETFs are called exchange-traded funds because they trade on an exchange just like shares. In South Africa, this exchange will be the Johannesburg Stock Exchange, or JSE. An ETF is therefore a listed instrument. As the shares are bought and sold on the market, the price of the ETF changes throughout the trading day. An ETF is not the same as retail investment funds, such as collective investment schemes, as these are not traded on an exchange. ETFs are cost-effective and liquid. Because there are multiple assets within an ETF, they can be a good choice for diversification. An ETF holds numerous primary assets, rather than only one like a share does. An ETF can own hundreds of shares across numerous industries, or it could be restricted to one specific industry or sector. Let's discuss the different types of ETFs. There are numerous types of ETFs available to investors that can be used for income generation, speculation, price increases, and to hedge or partially balance risk in an investor's portfolio. These include bond ETFs, share or stock ETFs, industry ETFs, commodity ETFs, currency ETFs, and inverse ETFs. We will discuss these in a little more detail. Bond ETFs are used to deliver regular income to investors. Their income circulation depends on the underlying bonds. They might contain government bonds, corporate bonds, state bonds, and local bonds called municipal bonds. Bond ETFs do not have a maturity date. Bond ETFs normally trade at a best or discount from the actual bond price. Share or stock ETFs contain a bag of shares to track a single index or sector. A share ETF might track foreign stocks as well. The aim is to offer diversified exposure to a single industry, one that contains high performers and new entrants with possibility for growth. Unlike collective investment schemes or CISs, share ETFs have lower fees and do not contain the actual possession of shares. Industry or sector ETFs are funds that concentrate on a specific sector or industry. For instance, an energy sector ETF will contain companies operating in the energy sector. The idea behind an industry ETF is to gain exposure to that industry by pursuing companies operating in that sector. One example is the training or proficiency sector, which has witnessed a flood of fund inflows in current years. If you are looking for general exposure to this sector, buy an ETF tailor-made for this. The underlying companies will give you general exposure to this industry. Industry ETFs are also used to rotate in and out of sectors throughout economic cycles. This is like sector rotation. The downside of investing in ETFs is that the investment does include direct ownership of the underlying shares. Commodity ETFs. Commodity ETFs capitalize in commodities, including crude oil or gold. Commodity ETFs provide numerous benefits. First, they differentiate a portfolio, making it easier to hedge downturns. Commodity ETFs can deliver a pillow during a crash in the equity market. Holding shares in a commodity ETF is cheaper than physical possession of the commodity, because the ETF does not require insurance and storage costs. Currency ETFs. Currency ETFs are joint investment movements that establish the performance of currency pairs containing domestic and foreign currencies. Currency ETFs serve numerous purposes. They can be used to speculate on the prices of currencies grounded on political and economic developments for a country. They are used to expand a portfolio or as a hedge in contradiction of volatility in current markets by importers and exporters. Some of them are also used to hedge against the risk of inflation. Inverse ETFs. Inverse ETFs allow traders to receive gains when equity performance deteriorates. An inverse ETF uses derivatives to short a share. Shorting is when you sell a share, expecting a decline in value, and repurchase it at a lower price in order to make a profit. Basically, they are bets that the market will weaken. When the market weakens, an inverse ETF increases by a balanced amount. Investors should be conscious that many inverse ETFs are exchanging traded notes or ETNs, and not true ETFs. An exchange-traded note trades like a share and is often supported by a bank. Let us quickly discuss the concept of an exchange-traded note, or ETN, that we referred to briefly on that last slide. A relatively new range of products listed on the JSE and typically issued by registered collective investment scheme management companies are exchange-traded notes, or ETNs. ETNs are listed, senior, unsecured, non-bespoke, and uncollateralized debt instruments issued by an underwriting bank. The issuing company has a contractual obligation to pay the holder of the JSE-listed ETN security a return linked to the performance of the underlying assets, security, or benchmark. This could be an interest rate, the performance of one or more shares or bonds, an index, an exchange rate, or a commodity. The ETN is backed by the creditworthiness of the issuer. A number of ETN listings have occurred from late 2010 to date on the JSE, bringing new areas of investment exposure to investors. The next question to answer is how to begin investing in ETFs. Investing in ETFs has become relatively easy because of multiple platforms accessible to investors. These are some of the steps that we will suggest. The first step is to find an investing platform. ETFs are accessible on almost all the investing platforms. Almost all of these platforms proposed brokerage-free trading, meaning you don't have to pay fees to the platform providers to invest or sell ETFs. Although a brokerage-free purchase or sale does not mean that the ETF provider will also deliver admission to their product without related costs. Some areas in which platform services can differentiate their services from others are suitability, services, and product variability. Some well-known brokerages, though, offer wide educational content that helps new investors become acquainted with and research ETFs. The next step is to explore the different types of ETFs. Almost the most important step in ETF investing is to research them. There is a wide variety of ETFs available in the markets today. ETFs are diverse specific securities like shares or bonds. That is one thing that needs to be recalled during the research process. When you commit to an ETF, you must keep the entire picture in mind. Sector or industry. Some questions you need to ponder during this research process are: what is your investing time frame? Is the investment for income or growth? Is it a particular sector or financial instrument that motivates you? The last step is to decide on a trading strategy. A good trading strategy, especially if you are just starting out investing in ETFs, is rand cost averaging or spreading out your investment costs over a period of time. This approach of investing ensures a disciplined approach over a period of time. It also assists and educates novice investors about the nuances of ETF investing. When you become more comfortable with trading, investors can move on to more advanced strategies like swing trading and sector rotation. Also, bear in mind that some of the ETFs also qualify as a tax-free investment account. To learn more about tax-free investments, please watch our tax-free investment accounts video. We have reached the end of this session. This educational video was brought to you by Nedbank Online Share Trading. Any examples used in this session are purely for illustrative purposes. Thank you for your time.